Hello and welcome everybody to our quarterly eToro Popular Investor Call. And we have a great panel of guests today to talk through lots of different subjects over the market and the economy. So without further ado, I will introduce the panel to everybody. And I'd like you just to say a few things about yourself to introduce yourself. Just before I get started, I want to say that what we put forward and the arguments and the discussions that we have are not financial advice. So please do your due diligence and be responsible for your actions before you invest. And we are not employees of eToro. So to get started, we will start off with our two special guests that we have on the call today. So welcome onto the call, James and Wesley. James, if you want to start off by introducing yourself, that would be great.
Sure, I'm James, or Campervans on eToro. I've been with eToro for 7 years. I've been in the finance industry for about 13 years now, most notably as a private banker and also the owner of a fintech company. I'm based in Dubai, keen wakeboarder, keen beach volleyball player, and keen enthusiast on the markets.
Great. Thanks very much, James. And over to you, Wes, if you want to introduce yourself.
My name's Wes. I am Wesley on eToro. I have also been on the platform for about 7 years. I am a South African immigrant to the United Kingdom. The UK loves immigrants like me. And that's why we had Brexit. I have a background in technology. I've worked in technology since I was a teenager, doing various types of consulting across the technology spectrum before moving to London in 2008, when I started building a consulting company here. Okay,
thank you. Thanks, Wes. And over to Simone, if you could introduce yourself.
Hi, everybody. I'm Simone Rizzetto 𝗍𝗶𝗲 on eToro. My background is a little bit between computer science and biology. I like investing in healthcare stocks, biotech stocks, and tech stocks. Right now, I work as a scientist here in Singapore, and I think that's it for me.
Okay, thanks very much, Simone. And over to you, Amar. You could introduce yourself.
Hi, I'm Amar Singh 1234 on eToro. I started on eToro about 2.5 years ago. I started my YouTube channel called Investing Education about 3.5 years ago. Basically, the goal was to invest my own personal money and to learn along the way. Halfway through that journey, I discovered eToro and I thought I could help others as well. I work as a lawyer part-time and I'm transitioning to a full-time investor.
Okay, thanks very much, Amar. And lastly, over to you, Maverick. You could introduce yourself.
Hi, everybody. My name is Maverick Goh and Nathan Dimitri in the eToro. Yeah, I'm with the platform since 2020. Yeah, and I'm based in Malaysia, and I'm working in the real estate industry. Yeah, that's all.
Okay, thank you, Maverick. And just lastly, I'm Stephen, and I've been on eToro for the last 5 years or so, but I've been investing in all different crypto and also stock markets for a long time. And I have over 12 years of investing experience. And I've also lived around the world and worked in senior professional roles in different countries around the world. But now, for the last couple of years, I've been a full-time investor. So we will get started on some interesting topics now we've introduced ourselves. So I think the first topic I wanted to talk about was really to do kind of a roundup of what happened in the last quarter. And especially last quarter was an extremely volatile time. I think it's no surprised that the markets were down quite severely during the last quarter. So it affected many people's portfolios. So I just wanted to talk through some of those issues with you as a panel. So if I start over again with you, James, if you could just give us a little bit of a summary of some of the major talking points that happened in the last quarter, and maybe anything that you did specifically with your portfolio in order to try to combat those issues.
Sure. So I think that the key theme probably starts of this quarter, or this quarter just gone, probably started in November of last year, when the Fed started changing its positioning, becoming more hawkish in response to high inflation. So just a couple of months ago, we were looking at going into this year with like a 25 basis point hike. And that's rapidly changed to like a nearly 300 basis point hike. And this has, you know, a significant impact on how you value any stock or any asset, to be honest, and has really been playing on investors' minds and has created downward pressure, particularly in growth areas. Another key theme, I would say, was probably what's been going on in Russia and Ukraine. It seems like the market somewhat is complacent to this risk still. When we look at the Euro stocks, they dropped maybe 8% and they've already recovered, which doesn't seem to be really fully recognizing what's going on there. I think that the key opportunities in the last quarter was probably in the commodities markets. So in things like wheat and nickel that come out of, and aluminium that come out of Russia or are indirectly tied with the Russia situation. So as sanctions increase, because of the conflict, it's becoming harder and harder for those commodities to move. And commodities move slightly differently than stocks, and the fact that they're very concerned about what's happening today and not what the future looks like. And you can also see these like exponential ticks up in commodities, because if there isn't enough of something and there's a lot of buyers, it just goes to the highest bidder, right? So you can see these really, really big upticks. So I'd say that I think the biggest wins in the last quarter were definitely in the commodities space, you know, because of that outlook. I also went into the year quite cautious because of what's going on with the Federal Reserve. So a number of my shorts performed quite well as well in high growth areas like Square and Zoom and so on.
Okay, so just while we're on that, James, your kind of long short positions that you had, is that something that you had in place anyway, or it was something like a strategy that you've been pursuing for a long time, or did you put that in place because of the volatility and the weakness in the market?
Yeah, so I put it in place maybe April of last year. Actually, I think it had maybe a slight negative impact on my performance last year, because it seemed very much like inflation was getting out of control from the beginning of last year, and there was a risk that the Fed would react very quickly and that would shock the market and there'd be this. But what the Fed has done is sort of given the market a lot of time, like notifying very much ahead of time that interest rate changes are going to happen. There's been no surprises and so on. So that whole thing took a lot longer to play out than I thought. So maybe what I lost in performance last year, I've gained in performance this year. By having a long short strategy, and the general theme is like short growth and then long sort of more predictable income type stocks. Okay, and that helped you to smooth out your volatility. Yeah. Okay. All right. Thanks, James. Over to you, Wes. Was there any kind of key themes in terms of your portfolio for the last quarter? Did you do anything differently? And how did things such as inflation, supply chain issues affect your portfolio? So
my strategy is a little different to James, who's got a bit more of that macro view. I'm more a bottom-up investor. And I know that James does a lot of that too. He puts out some really good insight on companies, but for the bulk of my portfolio, basically all of my portfolio, I tend to look for strong businesses, have target prices to buy them, buy them, and if they drop, then continue to average into them and to hold them for multiple years. So I'm aware that in moments like we're having right now, those people that have hedged well, they avoid the volatility of these periods. Well, some of them do. The successful ones avoid the volatility. But I wear the volatility. So in the same way that I did during the 2020 collapse in the market, I think during March, at some point, my portfolio was down 30%. But by the end of the year, I don't have the stat in front of me. I think that my portfolio was up overall 50-odd%.
Yeah.
So I've built the gut to wear these types of rides, and effectively that's my strategy. But I know that for a lot of new investors, especially 𝗂𝗶𝘲𝗄𝗧, it's a little too much to bear. But it's worked for me over my 2 decades or so of investing. Just need some patience and a gut for red.
So you try not to hedge, and you keep your investing strategy consistent, but you try to catch up on some of that volatility.
So I
bounce back.
Yes, so I might hedge, but probably in a much smaller way. So for example, I would use cash as a hedge. I might go to cash. I added some money to my account recently, and that cash becomes a part of my hedge against volatility, and gives me buying opportunities when the bottom falls out of the market. I also do, I would hedge possibly by taking opposite positions on indices.
Yeah.
When I think that the market is, for example, if we have a bull run and the market's been running green every single day or every single week for 3 or 4 months, and you're just about to head into an earnings season, you can be pretty sure that you're going to see something taken off of the top of the market before going into that earnings season. And right now I'm looking at the market at the close on this Friday, or through the 3 days and then ending on Friday, suggests that we might see some strong downside. We'll have to see what happens on Monday. But we see some of the big names, mega caps, starting to roll over. Google below their 200-day moving average now, which might suggest there's more downside. And if that's the case, I want to see what happens on Monday. Then maybe a short on 𝗂𝗂𝗂𝗂, or taking up a position in 𝗂𝗂𝗂𝗂𝗂 might be the wise move.
Okay. And what's your views on rising interest rates and the effect it might have on technology, for example? Because I noticed you have some technology stocks in your portfolio. Do you have a viewpoint on that?
Yeah, so my portfolio is largely technology stocks. My background is technology. So I tend to really understand the companies, the management teams, their history, their strategy, their products, their product roadmaps, before I buy them. I live with these companies for many years, and I might buy into them for 3 years and then sell out of them when they get expensive, and then 2 years later I'm back into them. So I think the market has gone a little bit crazy. It went crazy before, right? But it was in the bull direction through 2020 and part of 2021. And now some of that craziness is unwinding. And when this craziness happens, it's not all rational. The same way it wasn't rational when things were going up, it's not rational when things are going down. Yeah. So there are lots of technology companies that will be fine with an interest rate of 2, 3, 4%, because they are strong, proven businesses that are generating their own cash flow. They're growing fast. Even in an environment where economic growth is slowing down, there's still going to be some of the best growth engines in a slower economy. So that's the way that I'm viewing it. I know that the irrationality can last for a very long time. And it's fun when the market's going up, and it's painful when it's going down. But you kind of need to wade through that noise, right? And find the right kind of companies, for my strategy at least.
Yes, yes. And I suppose a lot will depend on the way that the Fed implements the increasing interest rates, and how strongly they do that, and how much they increase those interest rates, and how many times throughout throughout the year.
Right. Yeah.
But it'll be very interesting to see once they start to increase those interest rates, whether if there's a pullback in the market, whether they pause for thought or they make sure that they fight against inflation. They have a very difficult position, the Fed, to be honest.
They do. I don't envy them at all. But the market is already priced in, certain sized increases through the year over a particular period. The bond market gives you hints as to the expectation of the wider market. But I agree that that'll affect the movement of the market in the short term.
Yeah.
But in the long term, it's the journey doesn't matter as much as the destination.
Yeah.
Strong businesses are going to continue to be strong businesses for years and years to come. Even if there's a recession, right? Nobody wants a recession. That's another painful thing that might occur. But it's not like the world shuts down when there's a recession. There are still companies that are growing through recessions.
Okay. All right. And Simone, if you want to just talk a little bit about what happened in Q1 for you. And I also just want you to as well touch upon inflation. Obviously, we've had a lot of inflation within 2021 and then on to 2022 and how you think that might possibly go and what may happen.
Okay, how it was for me the past quarter, I think stats speaks for themselves. I think the last quarter I was down 12%, so it was obviously bad. I'm not hiding that. I've been heavily affected by the inflation as well. The key reason why it was kind of painful is I have a kind of high exposures to biotech stocks. So compared to larger pharmaceutical companies, biotech stocks don't have products on the market yet. So they are heavily exposed to possible events like higher interest rates and inflation, and they have very high risk, so they go down a lot. And that part of my portfolio was probably one of the major driver of the performance in the past quarter. Similarly to Wesley, I'm not really hedging my portfolio. Right now, I'm more worried about missing out on the rebound rather than going down for another 10%. So I'm willing to go down a little bit further to be sure that I'm going to be there when the market is going to rebound. So that I still have some kind of edge against inflation. So mostly I'm exposed to biotech stocks, but I also have larger pharmaceutical companies, which they kind of works in the same area, but they are very different in terms of how do they respond in similar markets. It's known that pharma typically do very well in high inflation environments like this one, and indeed some of them went quite well in the past quarter. But I think maybe too well, more than what I expected. So now I'm slowly starting to sell a bit of them and put my money into riskier stocks. So yeah, so that's what I'm trying to do. In terms of what inflation is gonna do in the past year, I don't think I'm qualified enough to make any prediction. Also because many things cannot be predicted. Maybe like a year ago, people that were trying to predict inflation was not considering at all geopolitical situations like the one we are experiencing now. So it's gonna be almost impossible to predict what is gonna happen.
Yeah, I think
I don't wanna make that bet.
Yeah, that's fine. I don't think anybody priced in the fact that there was going to be a war between Russia and Ukraine. Obviously, there has been supply chain issues in the market for a while, which has obviously been worsened by certain events that have happened. But yeah, I mean, some of the inflation that's happened in the last year has been absolutely insane. I saw a figure the other day which said that used cars have gone up by 40% from January 2020 to January 2021. Absolutely massive increase in those second-hand cars. And even the price of new cars has gone up quite considerably as well because of the chip shortage. So, I mean, yeah, it's very difficult to see what will happen in the future. But does any, Amar, do you have any viewpoints on whether you think that inflation might start to not go down, but do you think inflation will start to calm down a bit? Or I suppose a lot of it depends on supply chain issues. What do you think?
Yeah, I mean, like Simone, I don't think I'm really qualified to gauge where inflation is going to go. If I knew where inflation was going to go, you know, I would be a very rich guy, I think. What I'll say is that I know my dollar buys less of, for example, bread, but it seems like my dollar is able to buy more of Facebook stock or PayPal stock. And so in a way, I mean, my dollar doesn't seem to be weakening because I can buy more of these good quality businesses which have fallen down quite a bit. My strategy is a long only strategy, so similar to Wesley's strategy. I try to be a little bit more concentrated, so that can make the portfolio a bit more volatile. The thing with inflation is that bond rates have gone up to about 2.5 to almost 3%. But I still don't think that they're attractive enough to shift from equities. I think stocks like Facebook and PayPal have a cash flow yield of about nearly 5% to 6%. So if you look at it on that basis, they're still more attractive than bonds. So unless we see inflation really get out of control, and more importantly, bond rates, bond yields go out of control, I'll still stick to holding my companies, quality companies for the long term. I think that's the best way to go.
Okay, all right. Thanks, Amar. And Maverick, any points from Q1 that you want to talk about in terms of how some of the key elements may have affected your portfolio or the market as a whole?
Yeah. Okay. Basically, currently year to date, my portfolio is down around 20%. Yeah. And basically, my strategy is to buy the dip on the strong fundamental companies and the crypto. Yeah. And actually, I'm quite excited for the future currently because if you look at the current market, it's all sector is down. Even though the good fundamental, there's a very strong company, everything, and the crypto as well. So I think there's a very big opportunity when the market is down. Yeah. So yeah, I just going to add the cash position to my portfolio, and we'll see when there's a very good opportunity, I will just buy the strong fundamental companies. Yeah.
Okay, thanks, Maverick. And I guess we shouldn't all be doom and gloom about some of the issues that are happening at the moment. And also bear in mind as well that the employment market is quite buoyant. We've got almost record low unemployment rates that are happening at the moment. We seem to be getting over COVID-19, unless you're in China, and then perhaps not at this current time. But I think the winds are shifting on COVID-19, and I think people are much more willing now that vaccinations have happened to live with it for longer, and it's going to hopefully have less of an effect on the portfolio. So there are some positives that are going on at the moment in the economy as well. James, I wanted to ask you, because I know that you're fairly heavily into commodities at the moment, and I wanted to get your viewpoints on your commodity position. So we could talk about oil and maybe precious metals, and why you're bullish on them going forward, and some of the key tailwinds that you can see that might drive the price higher.
Sure. I think across the commodity spectrum, there's many stories going on, all very bullish for commodities. And a lot of this is that the market's incredibly constrained. Like one of my sort of macro views is that what's going on with inflation and Fed and all that sort of stuff is more of a demand problem than a supply problem, and that there's too much demand rather than too little supply. And this demand sort of spreads across everything. People are buying more of everything. So there's a greater demand for commodities. And then you can break down each of the commodities into sort of like buckets. So you've got energy, which is heavily disrupted with what's going on in Russia and Ukraine. With the sanctions that are going on, it's very difficult to move oil, and oil's being pushed very much east at the moment, which constrains the market quite heavily. And on top of that, there's been like multi-decade underinvestment in oil. So this has sort of been happening anyway, and it's just recent catalysts that make it look like, at least in the short term, energy is going to get more expensive. But the energy market is very good at sorting itself out over like a 9-12 month period. Then on the gold side, I think there's never been a time, certainly since I've been investing, where there's been a more bullish case for gold. It's kind of forgotten. It used to be 5% of everyone's portfolios, and it didn't really move too much. So people, and we haven't really had to worry about inflation and geopolitical risks. So people kind of forgot about it somewhat. But there's going to be a
change price in 10 years as well. So that's probably another reason.
Exactly. So it seems really unexciting. But as the world sort of goes away from dollarization, as there's more and more sanctions put on different parts of the world, other countries like China, for example, might be considering that they hold trillions of dollars of US debt. Maybe they want to hold other currencies or other stores of value. And it's likely that within a diversified holding structure, like gold is going to be a dominant one. So there's a lot of buying forces on the retail side. Retail demand for gold has never been higher. It's very good in inflationary environments as well. So I'm quite bullish on gold. And then and then I would say the third bucket would be things like wheat, which is obviously Ukraine is like the breadbasket of Europe. They produce a huge amount of wheat there, and it's sort of multi-level. The challenge is there in the fact that even if it can be produced, then the free movement of it might be constrained. We're seeing this sort of like global siloing of onshoring of goods as countries become a bit more hostile to each other, and wanting to keep foodstuffs in their country, which makes the market incredibly tight. And like I say, the exciting thing about commodities is if you get a constrained market, you see these sort of exponential upticks rather than this sort of like linear uptick that you see in stocks. And they're very much, like I said earlier on, like a reflection of what's happening right now rather than a forward-looking metric. So I think in most commodities, these things will like iron themselves out over the next 12, 18 months. But at the moment, I absolutely see a lot more opportunities in commodities.
So do you think there's still quite a big upside in oil? Because obviously oil price reached its kind of yearly high. I think it was, $129 a barrel. Do you see a lot of upside still to come from oil? And maybe what are some of those risks that might stop it going higher as well?
Sure. So I'll split that into like short term and long term. I think short term, there's absolutely a greater chance of upside than there is downside. And like asymmetry when investing is like the sort of opportunities I like to look for, where there's a greater chance of up than down, although it's impossible to entirely predict. Longer term, I think it's probably going to settle closer to a longer term average of like maybe $80 a barrel or something. But we're talking like 12 months from now. And the key and the only thing that I can see that could happen that could stop it going higher, because like I say, it's like an incredibly constrained market and there is a lot of demand, and there's no demand destruction at $100 or $120 a barrel. Like demand destruction comes in at like 140, 150, 180, according to 𝗁𝗵𝗲𝗃. The only thing that could cause downside is like an Iranian deal and Iranian supplies come back online, or a broader shutdown in China, who's a huge oil consumer.
Or a resolution to the war, right? Because Russia's still the second highest producer in the world.
Yeah, absolutely. And I think over a 12 or 18 month period, that would be the case, but I can't see the sanctions going away, even if there's a resolution to the war very quickly. And there's a lot of breakdown in the supply chain of getting the oil out now. And again, that takes time to reverse. So even, best case scenario, turning that the other way would take 2 months or 3 months. So short term, I see upside. Long term, probably remain quite stable.
Yeah, I think you're right. I think there's different arguments. I think there's a short-term argument that a lot of it's going to move around with the different pieces of news that comes online, and then there's kind of the more natural oil price, which comes from supply and demand factors without wars and other things involved. So okay. All right, that's excellent. So in terms of your portfolio, so you'll probably look to scale out of some of those commodities once they reach higher prices?
Yeah, over the next sort of quarter, over the next 1 to 2 quarters, I'll slowly reduce those positions. I think gold is a long-term story though. I think I'll hold gold probably longer than that.
And those, I think it's going to be very correlated as well, because obviously the higher the oil price goes and the energy costs, then it's going to really, it could really affect inflation.
Yeah.
Do you expect it to have a big effect on inflation over the next couple of months?
Yeah, I think to some extent we're kind of seeing that at the moment as well. But I do think that commodity prices haven't been fully priced into earnings. I think it will be this quarter or maybe next quarter that we'll start seeing the effect of higher input costs having effect on corporate earnings for companies that produce things. Obviously, that's less of an effect on tech stocks. Yeah. Okay.
All right. Great. And Wes, do you have any points on supply chain and how it may have affected any of the companies in your portfolio?
Yes. So, I mean, several of the companies have been affected or part of the chain of effects. Having worked in many technology projects over the decades, one of my key sayings is everything takes longer than you think.
Yeah.
And I have to tell myself this all the time. And so the resolution of the supply chain issues, I think like TSMC was saying last year in June, we will have solved the chip shortage for automobiles, new automobiles by June. And obviously that came and went, and it's still not resolved. I think I saw Honda put out something yesterday saying they need to cut their production in half or by 40%.
Yeah.
Because of the chip shortage. And so there are various companies that I invest in that need chips. Everything needs chips these days, but those costs affect their revenue and earnings. But there are also companies like AMD that I have owned on and off for a decade now that are affected, or Micron as another example. So I think that the supply chain, the error in people's thinking is that supply chains will all be solved at the same time, but there are different supply chains, and the issues will be solved in different timelines. And so it's more constructive to think about the companies that you own and look at their specific supply chain. So, for example, a company like AMD needs to source a number of raw materials.
Yeah.
So you need to see if any of those raw materials will be challenged at the moment, or by the conflict in Ukraine, right? So I think, is it neon gas? There's a noble gas, and a large portion of that noble gas comes out of, I can't remember if it's Russia or Ukraine, and that's an essential element in the creation of certain types of chips. So unfortunately, I think some of those will drag on, but chip shortages also have their benefits, right? So they're helping the prices of companies like Micron and AMD. And I think that might continue for a little while longer. The tricky thing, the hard thing to divorce is the change in secular demand from the effect of supply chain issues. So as an example, GPUs, graphical processing units, are becoming more and more popular, not just by gamers, but also by automakers and various other companies. So there's a change there in demand, but also there's a supply chain issue, and trying to marry these two things to get clarity on the long-term picture I think long-term, the picture is a bit clearer. The short-term and medium-term picture is a bit more difficult to establish. So I think a lot of the time people end up guessing. Yeah. I mean, if TSMC can't get their timelines on their own business right, you know, what hope do we have in the short and medium term?
Yes, and I think it's going to be different in each country, and I also wonder whether it's going to make the whole world reconsider the supply chain process, because if we look at, like, say, over the last kind of 10 years or even longer, then we've generally gone to countries which can produce the most efficiently at the lowest cost in order to be able to supply specific products. But that has left a dependency on certain countries, right?
Yeah.
And then these things only come out when you have such things as wars and political tension, which stops that supply chain. So yeah, I wonder if we're going to try, the world is going to try and reduce its dependency, and as James said, like maybe try to localize some of the manufacturing or some of the output.
And you're seeing that with Intel as an example, trying to rely less on foundries in different countries. The US wanting to invest more in their own solar capabilities. Yeah. But I have a sneaking suspicion that most of these attempts are going to fail. Yeah. There's a reason that the world moved towards these other types of models and that they've been so successful for so long. And there's a bit of a recency bias, right? So we've had a pandemic, so now everyone's scrambling to create resilience around this particular situation, which has happened once in the past 100 years, right? So it's a very rare event. Maybe we shouldn't be building too much resilience around ultra rare, high impact, but ultra rare events. So I'm very interested in how Intel plays out and some of the other solar players play out. But I have a feeling that the global model has been successful for a reason, and we'll slowly shift back to that. But that could be a 10-year experiment, 15-year experiment.
I think it could be a long time. And I think a lot of it depends on also what happens with in terms of China and Taiwan. Obviously, there's been a lot of tension as well this year. Hopefully that they've been put off by the sanctions that have been put on Russia for such an invasion, but that would have a major impact on semiconductors, for example, definitely in Taiwan.
Yeah.
So yes. Okay. All right. So Simone, if we look at supply chain again, do you think that some of those supply chain glitches should get a bit better in time? Do you think they're going to? Do you think they could improve, or do you think they could get worse first?
Depends on which sector. Yeah. So Wesley,
maybe in terms of biotech, maybe you can sort of talk.
Okay, that is a very special case. You know, the demand of that depends on people getting sick or depending by the disease. So obviously, demand for vaccines, COVID vaccines and COVID pills is going to reduce. We had problems in supplying enough of them early last year, but that one it's resolved now, and I don't think it will be an issue anytime in the future. You know, I don't think so. demands will be affected. Actually, maybe can increase a little bit for some diseases, because during pandemics, a lot of people miss their screening, and some diseases has been not diagnosed, or like will be diagnosed more later on in the future, when hospitals will catch up with all the screenings that they missed out. And so probably, especially for cancer, the demands of drugs can increase a little bit, but that won't be an issue for like providing enough of them. Yes, so that is not going to be an issue. For chip, the only things I can say about that is I can see that the GPU prices are getting back to a bit more normal levels. Now you can actually buy GPUs. Just recently, I think a few months ago was completely impossible. I don't know if that's a good sign. It could also be that, you know, people are just giving up, and because of inflation, they are trying to save money and not buying a new gaming machine or new gaming computer. But it can also be because of Bitcoin mining. The profitability is decreasing. So that could have also played a role in this. On the long term, I think cloud computing can also play a role in helping reducing the demands for chips, because you will make a smarter use of chips in the clouds compared to what you do in if you buy your own chip for any applications you have to do, because it will be kind of everybody sharing the same chip. And also, I'm not sure about this, but I think it could help the manufacturing process as well, because creating GPUs for cloud, it's different from creating GPUs for laptops or PCs. When you build a GPU for a laptop, it needs to be small. So that put a strong limits on what you can do. But when you move into the cloud, if you build a GPU that is as big as, you know, the 1980s supercomputers, it's still acceptable. So that could play a role in the future. So I don't know, it's still too early to say, but yeah.
Okay, yeah. And I would be amiss to, we've got a scientist on this call, so I wanted to ask you about COVID and the obviously lifting of quite a lot of the restrictions that have been in place, and some of the treatment that's been put in place for people who have more severe cases. What's your kind of view as a scientist on what about COVID-19 and its future path?
So it looks like the worst is in the past now, but it still can cause damage, especially if people will start to believe that they don't need protections anymore. So if they said, oh, we don't need the vaccines, we don't need the antiviral pills, we don't need a mask or anything, that's when things could get worse. But so right now, as we remove all the protections that we are like social distance, mask, traveling restrictions, we are relying on our own immunity. So we need to make sure that our own immunity is strong enough. So that means we will still need vaccine, very likely, especially for the most vulnerable people. Could also become annual things. That would be definitely be a good things for Pfizer, BioNTech, Moderna that are selling this vaccines. Yes.
But I guess the major risk is some rogue variant that comes that's much stronger and is, you know, causes more hospitalizations, more fatalities. But over time, that's less likely to happen from a biological point of view, right?
Okay, so there are like many things to say about that. It's always possible, but any new variants can be treated as a kind of new virus. So you can have a localized lockdown if there are mechanisms in place to monitor new variants. So that means sequencing virus continuously. So make sure that potential new variants will be discovered in times and then isolated, at least the one of concerns. In general, for the way virus works, they tend to become to not kill the host. So if they evolve, their evolutionary pressures tell them to not kill the host. So they should like cause less and less damage and be more of a kind of passive or like asymptomatic infections. That will be a more successful virus than one that kills the host within 2 weeks.
Can't spread anymore.
Exactly. So, but that's not what always happens. So in general, it should be that way. So that's the more likely things to happen, but we cannot be 100% sure. So it's important that we will keep at least some of the defense that we built in the pandemic in place.
Yeah, I mean, it's good for the economy that things start to open up again. But I'm really not sure how effective kind of a zero tolerance policy on COVID and spread and the restrictions that are happening in China at the moment. I don't know how long they can withstand that really, because I think it's going to be extremely difficult to get the cases down to zero.
Yeah, I think China is more of a political crisis rather than healthcare crisis. Obviously, they have a very different population and compared to the Western countries, but you can see maybe India, which is have similar densities in the cities. Still, they managed to get away with the herd immunity and without having major lockdowns as in China. So
the balance between the economy and people's health, making sure people are safe. And now we'll move on to talk a bit about crypto. And crypto has obviously suffered over the last couple of months after Bitcoin hit its all-time highs in November. It seems to be very correlated at the moment to the other risk-on assets such as technology stocks and growth stocks. And we've seen a reduction in the Bitcoin price. I think it's currently sitting at about 39,000. So it hasn't quite sold off as sharply as some of the tech stocks, especially over the last kind of month or two. But it's quite interesting to see that correlation. I wanted to ask you, James, as you are obviously managing wealth for some very wealthy individuals around the world and in the Middle East. I wanted to keep this discussion a bit more focused on, rather than where the price of Bitcoin or where the price of crypto is going to go, more around kind of the institutional adoption. And the reason why I say that is because I think for a long time, people have been talking about that they want to get more institutions into Bitcoin and crypto. And then obviously over the last month or so, I've seen a lot of complaints from people that they're now correlated with the technology market. Yeah, so it's kind of people are asking for that institutional adoption. And then when it starts to behave like an institutional asset, then people start to complain. So I wanted to ask you, generally with kind of high wealth individuals and institutional investors, what their viewpoints are on crypto and how they are positioning that in their portfolio. Are they doing this? Are they taking very small stakes to begin with? Are they investing in the assets, or are they investing in the more in the crypto ecosystem of companies?
Yeah, I would say quite broadly, there's like definitely significant interest in this space from like a broad demographic, actually. And I think we saw, was it about 18 months ago that the first Bitcoin futures ETF was launched? Yeah. To great success. I think it has nearly $2 billion under management there, which for a futures ETF is quite considerable. I think that the real game-changing move would be the launch of like a spot ETF. I think the benefit of an ETF, although there's many ways that you can buy crypto, but the benefit of an ETF is that it can be purchased in tax wrappers. So all over the world, there's different structures, for example, pensions and things like that. And it's quite appealing to have to access crypto in a way that you won't be heavily taxed for certain jurisdictions around the world. So I think that would be a considerable move. From a base network point of view, like our bank's going to integrate into the pipes, as it were, of crypto. I think that there's a greater chance that crypto native financial institutions will become dominant before existing banks will integrate, just because they're so behind the curve on their own technology, doing it the old way, as it were. Most banks are written in a programming language where there's not many people alive that remember how it's how to write it. So we're more likely to see crypto native institutions grow up. But on the institutional front, I think there's never been a more compelling time for like a self-custody, decentralized asset that's accessible to everyone. And I'm not, and I think I share sentiments a little bit here in the fact I'm not entirely convinced that getting the old financial institutions on board with this is necessarily like long-term good for everyone. I think that the fact, because those sorts of benefits will go away, because typically people won't be self-custodians of their crypto. Maybe these institutions will start having influence over the direction, so it will become less decentralized. Yeah. And they obviously won't be working in the best interest of existing holders. So I think that the beauty of crypto is actually the fact that it isn't integrated into the old financial system, and it's an independent system of its own. And like I said, I don't think there's been a more compelling time for the values that it has. And I think that we have to wish carefully of where the direction or the future, we've got to be careful what we wish for in withholding those values.
So are they considering at the moment, like institutional or high wealth individuals, are they thinking about crypto and Bitcoin in general? Are they grouping it in as a risk-on asset, like very similar to like a technology stock or similar to 𝗁𝗓 𝗡𝗵𝗲 type of high growth, high risk type of asset?
Yeah, so I would say that the typical demographic that would be most compelled to this is probably retail, because it's seen as like a wealth creation instrument. It's seen as an instrument that could go up dramatically. It could also go down a bit. And high net worth individuals tend to be like more focused on wealth preservation. So they're very interested in things with low volatility that generate stable incomes and that sort of stuff. So I think that the real like upside potential is getting to the 6 billion people in the world rather than the last 1 billion, if you know what I mean, because it's more conducive with their goals.
Yeah. So have you seen examples of it where people have been switching from gold to Bitcoin, for example, or splitting that stake between them?
I'm not familiar of institutions that offer Bitcoin products at the moment from like a banking or institutional point of view. Only that individuals purchase separately. It seems to be like more of a self-brokered asset at the moment. People like set up an account on an exchange and purchase themselves rather than do it through an advised route.
I think a lot of people are. I've heard about a lot of institutional money managers who don't have it in a particular fund, but they all own it privately.
Yeah.
Okay. And do you think the fact that a spot Bitcoin ETF hasn't been approved yet is that a barrier for institutional investors? Like, do they want to hold the physical Bitcoin, or do they have issues holding, for example, futures contracts?
I think that I think the benefits of spot is like it's exactly the same as holding Bitcoin itself, and all of the risks and liabilities. And I think this is where some of the complexity over like regulating it come in, is the fact that because it's like a self custodied asset, there's obviously security risks. Whoever's holding it is holding it. So it's quite difficult to protect. So the ability for larger institutions and larger portfolios to buy an asset that's, that is essentially like managed and looked after at arm's length, probably insured, would be a lot more compelling than themselves trying to navigate the route of setting up their own brokerage and figuring out how to custody the asset.
Yeah, and there's obviously there's some arbitration issues as well. Okay. Yeah. All right. And Amar, I wanted to ask you about crypto. Do you hold crypto in your eToro portfolio?
The only crypto I hold in my eToro portfolio is Ethereum, and I hold a small percentage only. I still have my doubts over the crypto market in general. There's still a lot of fraud. I said this in the last call. I think a lot of crypto also masquerades as crypto when it's actually just a business, a normal business, and they're just tokenizing their shares. I think the watershed moment will come when we get the result from the XRP against SEC lawsuit. So then we'll really know if some of these cryptos can even be sold on exchanges. I think even eToro stopped selling Cardano in the US because of fears of regulation. So I still have my doubts over crypto. The other thing I said about crypto in the last call was that Bitcoin, that was my bold prediction, Bitcoin might change to a less energy intensive method. Recently, the CEO of XRP has come up with a movement called Change the Code. So they are trying to change the code for Bitcoin. So if Bitcoin moves to something more environmentally friendly, I might be more supportive for Bitcoin. That's the reason I like Ethereum better. I think it's just better for the environment. And of course, it has a smart contract functionality. And it has a very strong network among the crypto developer ecosystem.
Yeah, and there could be a bit of a move as well in Ethereum because of the Ethereum 2.0 integration, etc. So I think yeah, there could be some upside for Ethereum over the next few months, depending obviously what happens in the market as well. That's interesting. Okay. And Wes, are you invested in crypto at all, either in your eToro portfolio or outside?
I've got a touch in my eToro portfolio, but not very much. I might increase that because it's clearly in a certain trend at the moment, right? It's massively consolidating. Not people. I don't think I advertise very much in eToro, but I've been involved in crypto since 2011 or 12.
Yeah.
I had a mining rig with 3 GPUs in my lounge going 24 hours a day mining Bitcoin and then Dogecoin for shits and giggles. and I had over 1 million Dogecoin, but not until recently. I sold it about 4 years ago, unfortunately. Otherwise, I would have had quite a lot of money.
Yeah.
But yeah, I don't think anyone saw that coming, right? The founder of Dogecoin sold everything he had and bought a Honda Civic or something, and would have had hundreds of billions if he just held on for another 2 years. But I mean, no one could foresee that a crazy billionaire inventor would suddenly have Dogecoin as his favorite crypto and put it all over the internet.
Elon Musk has definitely done a lot for the Dogecoin price and adoption.
It's very good at PR. But
are you generally quite bullish long term on crypto as an innovation? And are you more of a Bitcoin person, or are you more interested in a lot of the different altcoins?
So I have different opinions. I actually think the blockchain technology is a very poor technology. It's heavy-handed at what it does.
Yeah.
It's expensive. It uses lots of data. It's slow. Well, I know that there are innovations that change some of this,
yeah.
but the world chose blockchain, and so it doesn't matter what the technology is like. It's not always the best technology that wins, right? It's what the bulk of people eventually select. So in terms of technology, you know, whatever. But I know that there are lots of solutions out there that are poor but very successful. I think that Bitcoin has earned its place in the world, and just purely by adoption and mind share across the entire financial spectrum. It's becoming more and more like a digital gold. The others, I think, less so. They still have to prove themselves. Ethereum, I think, is great because it has a leader, it has a figurehead, and to be successful in lots of technology companies, you usually have to have, ironically, some kind of centralization in terms of leadership and decision making.
Yeah.
And it's the basis for so much now, right? So it's I know that some of the things built on Ethereum are falling out of favor now. So I think NFT usage has fallen through the floor for now. But still a lot of stable coins are built on Ethereum too. So outside of eToro, I've had a buy and hold portfolio that I have not touched. I bought, I don't even know, I can't even remember when, 2015, 16. And I added some Rune. I don't know if anyone knows about Rune, the crypto.
I have 𝗬𝗂𝗊𝗄. Yeah, I've had that for quite a long time. Yeah, done pretty well.
It has done very well. So I added that probably 2 years ago, but that's the only thing I added. I've just in there, I've got Bitcoin, Ethereum, and a smattering of other things that haven't been as successful. So there I'm just buying and holding, and it's the type of thing where I think I maybe threw 10 or 15 US grand into it back in the day, and it's done very well. And it's, I think at one point it went down to like 3 grand USD. But also it's been in, you know, the hundreds of thousands of dollars at points in time.
Yeah. So
it's one of these things where I'm just, you know, if it ends up being a life-changing amount of money, fantastic. And if it doesn't, hey ho.
Asymmetric.
Exactly. And seeing how it changes the world, or if not, is just something that I keep an eye on, right? So as you said, everyone was very keen for there to be adoption by financial institutions, because that would drive the price higher. And then when the financial institutions do adopt it, they realize, hang on a second, is this going against the ethos of crypto? Has crypto just become another thing in the financial system, and it's actually not doing anything that those early white papers wanted it to do?
Yeah.
So it's interesting from a societal and philosophical perspective too.
Yeah. I think what people forget is that decentralization is a scale. It's not black or white, right? And sometimes you want decentralization, and sometimes you don't need decentralization, but you want something that's faster, easier, quicker to transact. But obviously for large amounts of money, you probably want something that's much more decentralized, and which may be slower, like Bitcoin, but kind of has those store value properties. But the way I consider a lot of altcoins, especially the early altcoins, is I consider them more like VC bets, to be honest. If you hold a lot of altcoins in your portfolio and projects that you find quite promising, I think obviously, just like any startup, I think it's quite likely that the majority of those altcoins won't take off, right? They'll either go to zero or they'll peter out and not earn much money. But it only takes, 2 or 3 of those altcoins to surge, like like 4chain has, like Solana has. I was in quite early on Solana, which was great as well, because that has gone up a lot. But those ones that are successful are really going to dwarf the ones that go to zero. So I really consider it more like those as a VC type of bet, and Bitcoin more as a kind of a store of value. Okay, so I wanted to just to end things by talking about some of the key contrarian ideas that the panel might have. As I said I think before we started the call, I think investing in anything at the moment is contrarian. But I wanted to get some points from the panel on some key areas maybe which I think is underpriced or the market is kind of overlooking. So I'll move on to start with Maverick. Maverick, do you have a key contrarian idea that you want to share with us?
Yeah, I think the Chinese companies are significant undervalued right now, especially the good fundamental company like the Alibaba or the Tencent. Yeah, these are, yeah, I'm very positive on their future. Yeah.
Okay, thanks, Maverick. And over to you, Amar. Any contrarian idea you want to share with us?
So the contrarian idea I think that I want to propose is the industry called telemedicine. I think telemedicine is still quite new to us. I mean, we saw a big boom during the pandemic, but actually, I think telemedicine was doing quite well even before the pandemic. So the view now seems to be that post-pandemic, you know, a lot of these telemedicine stocks are stay-at-home stocks, and they're not going to be as popular in the future. There's one stock in particular that I like. It's called Teladoc. So it's fallen quite a lot. It's trading even below where it was before the pandemic. But it grew a lot even last year when things started to open up. I think the revenue growth was about 80% last year. And that was on top of 2020, which had another very good year as well. Some of that was due to acquisitions though. But I think overall, I think people are overlooking the rise of telemedicine. I don't know about all of you, but I don't like going to the doctor at all. I want a doctor to come to me. You know, we are doing this call on Zoom right now. I think doctors can also do certain kinds of treatments on Zoom. Not everyone has to go into the clinic. I think it saves a lot of time as well. And it reduces costs as well. And I think there's a big problem in terms of rising healthcare costs. So telemedicine can be one of the solutions to that. So I urge you guys to look at Teladoc. I think is a rising star.
Okay, that's pretty interesting because again, telemedicine was one of those things that boomed at the start of the pandemic. Obviously, because people couldn't physically go and see the doctor. So the price probably got a little bit. Well, not a little bit. It got very overhyped against probably what the way it should have been valued. But it's probably gone the opposite end of the spectrum now. After massive decreases in prices, it's probably looking much more attractive. And I think you have as you said, you have the data. Like you want to see a doctor for something really serious where you need to examine you, right? But for your regular appointments or to subscribe, prescribe a prescription, there's absolutely no reason why it shouldn't be done online, right? Yeah. Okay. Over to Simone. What is your contrarian idea?
So I'm gonna connect to what Amara was talking about. So I think the whole field of biotechnology during the pandemic received a lot of attention. So a lot of investors came in and it rose quite a lot. Now there is an exodus and everybody is trying to move out especially for stocks that are heavily connected with COVID. For instance, Pfizer, a bit less Pfizer, but like BioNTech, Moderna, that were doing very well because of their vaccine. Now everybody is running away when we knew since the very beginning that probably revenue from this company was going to decrease a little bit. But for me, that is not a reason to sell right now, because that proved the technology is working very well. And there are a range of many other applications and indications that mRNA technologies can be used. One of that is obviously cancer, but also other infectious diseases. So I believe there is a lot more to come for them, and they could potentially revolutionize the way we deliver medicines to the body, because of right now, before building molecules like antibodies, you have to make them in a factories and then ship them around and everything. But now you can just deliver the mRNA that use the host machineries to build the antibody for you. So that's a new concept, and looking at that with a lot of interest.
Okay. And do you think, obviously, because it takes a long time for a drug after it's approved, etc., to start to make money, right? Is that is that a problem in this current environment with them increasing interest rates and companies wanting to be, investors wanting companies to be profitable more quickly than, say, in the past?
I think it's more than the time is the risk, the problem, because it's just not enough to start a clinical trials and wait 5 years to make money. There is a quite high chance that the trials will fail. But what Moderna and biotechs are doing, they are building a very robust pipeline. So they are, in some cases, they are also employing different technologies from just mRNA. They are relying on more classical therapies as well. Yeah, they are building a very long pipelines of different drugs and diseases they are trying to test. So I'm sure that at least some of them will succeed. Yeah.
Okay, thanks for that, Simone. And over to Wes. What is your contrarian idea?
So we discussed this a little bit earlier, but I'm going to shift a little bit. So there are various surveys out there. There's a sentiment survey that's one of the most commonly cited. It's very important, highly regarded sentiment survey when it comes to stock sentiment. And in the past week, I was just pulling up the exact number so that I'm not telling a porky. But here it says that bullish sentiment this week ranks amongst the 10th lowest reading, excuse me, in the survey's history. And I think this is running back 4 decades. So if you are bullish on just about anything, you are the contrarian to 90% of investors in stocks at the moment, according to the survey. So as you said, anything, if you're long anything at the moment, you're quite the contrarian. And I think there are lots of pockets that are particularly interesting at the moment. Some of the FANGs have sold off enormously through this year. Facebook, I think, is still down. Is it more than 40% year to date? And their forward PE through 2023 is something like 10. And so there are lots of areas where it's quite easy to be contrary. I think the challenge is that a lot of investors at the moment are still quite new to the market. There was a rush of retail investors to the market through 2020 and 2021, with everyone sitting at home, a bit of extra money, a bit bored. And so they haven't been through the volatility that the market can experience, not really anyway. And so a lot of people are running in fear at the moment. But one area that
they all had that stimmy, right?
Yeah. Well, in the UK, we didn't exactly have stimmies, but people had a lot of time, and some people had a bit of extra money in their pocket, depending on the social support. So there are lots of areas. I think that people, for some reason, aren't looking at travel very much, unless it's US hotels, which seems to be back to the levels, some of them at least, back to the levels that they were pre-pandemic. But airlines are still well, in most cases, still well off their highs. And lots of them are back to revenue levels pre-pandemic. They're carrying a lot of debt for some of them, but also they're saying that the forecast for booking growth is bigger than it's ever been through the rest of this year. And I don't see a lot of attention. People are more scared than anything else, and so they aren't looking at these particular areas of opportunity. So I think it could be a good, 12 to 24 months for the likes of airline stocks. Another area is streaming. So Netflix didn't do very well, and they are down, 60% through this year, and that seems to have hit other companies like Discovery, which is now Warner Brothers Discovery. But if you look at AT&T's recent earnings, which were just a few days ago, the Warner Brother Media division posted growth in the millions of subscribers through the past year or so. I think maybe 12 million subscribers and month-on-month growth. So investors have taken Netflix's issue to be issues across the streaming industry, and I don't think that's right. Yeah. Well, we have evidence of it not being right for Warner Brother Media in particular.
And they had a very specific, Netflix had a very specific content issue as well, right? Where they had a lack of content. I think they were previously licensing the content, and then they've now had to adjust that to making a lot of their own content.
Yeah.
So it's a different, I guess it's a different issue from streaming company to streaming company.
It is. And also they're very focused in a particular area of streaming. So Warner Brothers Discovery has different types of content. It's not all what's called scripted content. At Disney also, Disney's now at levels last seen during the fall, during the collapse of the market in 2020. And this is despite their parks reopening, and I think their CEO said last quarter that there was going to be a slowdown in subscriber growth, but still it's decent. And so lots of these stock prices have become absurd, and they won't stay that way. It doesn't mean that, the market's not going to fall further, because I think the market's terrified at the moment. But even if you were to pick up some of these stocks right now and they were to fall further, 5 years out from now, you'll be sitting on a decent gain.
You'll be happy you did it. Yeah. Okay.
Exactly.
Thanks, Wes. Over to you, James. What's your contrarian idea?
So I guess my contrarian idea would be that I'm quite bullish on the FTSE 100. I was going to be cheeky and pinch Wes's idea that he mentioned earlier. I also agree that bonds would be are a fantastic addition to portfolios at this point, both in the growth and also as a counter or as a hedge to equity performance. But I won't be cheeky and say that.
You didn't want to take
I think it's spot on. But I think that the FTSE 100, I think, will be the best performing market from here to year end. And a lot of that is to do with two key factors. One is like the construction of the market. It's very conducive with the environment that we're in. So it has huge exposure to commodities and energy. It has exposure to financials. Both of these do well kind of late cycle. Both of these do well in high inflation environments. And it's kind of just coincidence that the construction of the FTSE 100 is made up this way. I think if you were to create a portfolio for this type of environment, it kind of ticks all the boxes. And then the second thing is, like, it's heavily underloved. It's seen as like old and archaic, slow moving. It's underperformed year after year after year. And there's been negative news after negative news, things like Brexit and other things going on. So it's not really heavily looked at. So I think it will perform particularly well. So far, I think it's globally one of the best performing indices so far year to date. But I think that will continue to the year end.
Okay. And it's quite affected as well by the US dollar strength as well, right?
So the majority of companies in the FTSE generate their profit in dollars.
Yeah.
So holding a dollar portfolio shouldn't have too much impact on currency fluctuation.
Okay, that's very interesting because the UK market has been very underloved since Brexit. And I think, yeah, that is really a contrarian idea because, yeah, there's not been a lot of people looking at investing in the UK over the last couple of years. But yeah, you could be right there. Okay, did I do everybody?
What is your contrarian idea?
Just myself, yeah, okay. So my contrarian idea is China. And I previously said in the last quarterly call that we did that I expected China to outperform the US and the US indices. And what I actually said in that call is I expected the China for US to outperform China in the first 6 months of the year, and but China to outperform the US over the whole year. So far that is kind of playing out because although the US markets have been down, the Chinese markets have been more heavily down as well. But what I expect is I expect the Chinese market to start to recover for a number of different reasons. I think that the US and Europe are trying to tighten as much as possible and increase the rates. I think China are looking to support and provide kind of more stimulus, more liquidity overall, and an easing in the market. I also think that there was a lot of pain in 2021, that they suffered the pain a lot earlier than the US. So a lot of the stock prices are, you know, heavily undervalued. And I think that they put in these, the Chinese government put in the regulations around tech companies and tech clamp down. But I think they are starting to kind of look at those. And I think a lot of them have already been put in place already. I think a lot of the big tech companies already know the regulations that are in place and are willing to abide by them. And I think the Chinese government is looking to support as much as possible. Like recently, they've cut again the reserve ratio requirement, so providing more liquidity overall into the market. And I think, again, the stocks have been beaten down again because China's been in lockdown, especially the lockdowns that have been happening in Shanghai since March, I think March 28th. They've basically been locked down. So that has put further pressure on what was already a depressed stock prices in China. And I think once they do come out of that, I think there could be some more pain in the short term. But I think once they come out of that, I think stock prices could rally. However, there are some key risks in China. So one of the key risks is around potential conflict between China and Taiwan. I think that has been mitigated a lot by some of the sanctions that have been put in place in Russia. I don't think China wants to feel that economic pain that Russia are feeling at the moment, but that is always a risk. So generally, I still hold by my assumption that I think China, it might take a little bit of a while to come to fruition, but I do think in the second half of 2022, it will outperform the US indices. But we will see. None of us have a crystal ball.
Yeah, it looks like China's credit impulse has found a bottom. I mean, it's been dropping through the past year and a half, 18 months.
Yeah.
And it seems to have settled. These things always take a while. There's a lag between the efforts to stimulate the economy and the corresponding response. Unless it's the US. The US seems to respond very quickly to these types of things. But other markets, normal markets, there seems to be a lag.
Yeah, and they also feel, I think China also feels the front load of inflation because obviously they're the largest manufacturer of goods around the world, right? So they have to pay for the most raw materials, precious metals, etc. So I think that's had an effect on the profitability of a lot of Chinese companies, but I still think at the same time it will recover quicker from some of those inflationary pressures. Okay, well, I think we will wrap up there. And I really want to thank the panel. I think it was a really great discussion and we managed to talk about lots of different subjects. So thank you all for your time. And I really wish you a great next couple of months ahead for your portfolios.
Thank you, Stephen.
Thank you.
Thanks, Stephen.
Thanks, everyone.
Thank you. Thank you.